So this is part 14 of this multi-part video series for positional stock traders on the weekly chart. Now, if you have been following my YouTube channel, then you probably already know this, but it is worth repeating because this is a very important aspect of the orange trading system that we discussed a few days ago. We do 5 kinds of analysis on any stock before we buy: liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and lastly, market analysis. We have already discussed liquidity analysis, comparative analysis, technical analysis, and fundamental analysis. Why do we need to do market analysis? Because in William O'Neill's book, it is clearly written that in a weak market, 3 out of 4 stocks will lose money. Okay, so there is a 75% chance of losing money when the market itself is weak. So it is important to understand the direction of the general market. The good news is that MarketSmith and William O'Neill has already done all of the work for us. They have categorized the market conditions into 4 different types. As you can see here, the market can be in a confirmed uptrend or uptrend under pressure or rally attempt or confirmed downtrend. Why do we do market analysis? Because it helps us determine whether we should be buying stocks in this type of market or not. It also helps us understand what position size is appropriate in a given market condition. Okay. So, broadly, I will tell you what these 4 mean. Okay. Confirmed uptrend means the market is going up. Uptrend under pressure means the market is trying to fall from the top. Rally attempt means the market is trying to bottom out and come up. And confirmed downtrend means the market is going down. Okay, it's very simple. Uptrend means going up, downtrend means going down, uptrend under pressure means falling from the top, and rally attempt means rising from the bottom. If you just remember what I said just now, that itself is more than enough. You don't need to do economic analysis to get an understanding of the market. You don't need to understand things like RBI or inflation or interest rates or whatever is published in mainstream media. All you have to know is what is the market doing right now, and it will be in one of these 4 market conditions. Okay. Now, how do you check that? You go to MarketSmith homepage. If you scroll the homepage, see it's already given here. The current market condition is confirmed uptrend. Okay. So they have done all the work for you. So you don't have to think about all these things. Okay. They have already done the work for you. They will tell you what condition the market is in. And then accordingly, you decide whether you want to buy a stock or not and how much position size. Now you click view more here. See, it takes you to this page. Now this page is available for uh, free version holders plus paid version holders of MarketSmith. But you scroll down, you see history. They tell you from what period to what period, what was the market doing. Very fascinating information. So confirmed uptrend, uptrend under pressure, rally attempt, downtrend. So from 11th April to 17th April, it was a rally attempt. Now it is in a confirmed uptrend. Okay. Now, why is this important? Well, it helps us determine position size. So if the market is in a confirmed downtrend, okay, we do not take a positional trade. It's very simple. This we are only talking positional trading here. I'm not even discussing swing. So when the market is in a confirmed downtrend, no new trades. Okay, 50 to 75% of the portfolio should be in cash. In fact, I would say 100% of the portfolio should be in cash, at least more than 80%, because confirmed downtrend, it is very risky. Whatever unrealized gain you have in your portfolio, even that could get wiped out. So confirmed downtrend, no fresh trades, plus 50 to more than 50 to 75% in cash. Okay. If the market is in a confirmed uptrend, okay, then we are allowed to buy stocks, take positional trades, okay, with normal position size. Normal could be anything for you. Normal for some people is 6.25, for some it is 10%, for some it is 15, for some it is 20%. That's normal position size. Okay. You can do that when the market is in a confirmed uptrend or uptrend under pressure. The only difference between these two is that the element of risk here is slightly higher. So you have to be very strict with your criteria, especially the technical and fundamental. You can't be lenient. In a confirmed uptrend, you could be lenient. Like, for example, you have 12 fundamental criteria, right? Out of 12, even if seven are in our favor, I would probably take a trade. But when it is uptrend under pressure, and only 7 out of 12 are in my favor, then I might hesitate. I might say, okay, out of 12, I need at least 9 or I need at least 10. So I'm looking for that extra confirmation to compensate for that extra risk. Okay. I hope you understand what I'm talking about when I say 12 criteria for fundamentals, because I made a video on that. I discussed the 12 criteria. By now, you should have memorized those criteria. For me, it's here. Okay. I have not written it down anywhere because I'm so used to doing analysis. It's like I'm looking at 2000 stocks in a month. That's roughly 25,000 stocks in a year. So the market does not reward you for activity. The market rewards you for being right. That is what Warren Buffett says. There is nothing wrong in looking at thousands of stocks, but there is definitely wrong if you end up buying those stocks. Okay, you don't have to buy too many stocks. One stock a week is more than enough. Okay, if at all you get that opportunity. Rally attempt, of course, you are allowed to take a positional trade, but half position size. So if your normal position size is 10% and the market is in a rally attempt and the price enters that blue shaded area, instead of buying 10%, instead of taking a 10% position size, take 5% position size. Okay, it's very simple. Okay. So in the first three market conditions, you are allowed to take a trade, play around with the position size. When the market is in a confirmed downtrend, sit tight, don't do anything. In fact, the existing stocks that you have in your portfolio, uh, make sure you sell them or maybe put your stop loss at the break even so that you don't lose your capital. So that's market analysis. So now you know how to do liquidity analysis, comparative analysis, technical analysis, fundamental analysis, and market analysis. Based on that, you know how to select a stock and determine your position size. Now comes the next part, which is trade execution. So we'll look at maybe some examples. We will also look at the whole orange trading system again, just to summarize things, because there is filtering, there is shortlisting, then there is the 5 kinds of analysis. We need to come back to that macro view. We have to be very selective with our stocks. So that's why I have combined, if you notice in the technical criteria, I have combined the William O'Neill's and Mark Minervini's approach. So to get that extra confirmation. Okay. Thank you so much. I will see you in the next part.